Welcome to Corks Capital, Decanting Insights from Investment Professionals. I'm your host, Shanthan Pillay, and on the table, we've got Izak Odendaal and Warwick Three Cape Ladies. Izak, we grade our wines at three categories: clarity, nose, and palate, coming up to a final score of 20, and during the tasting, we'll talk about our topic, asset allocation. So let's kick off with clarity. No sediment, no tiredness. I'd give this a 3 out of 3.
Agree.
Now that we've cleared up the glass, can we hear a bit about who you are?
So I'm the chief investment strategist for Old Mutual Wealth and Old Mutual Multi-Managers. What that means basically is I look at macroeconomics, asset classes, politics, geopolitics, the intersection of all those things to try and help our clients get the right asset mix of asset classes in their portfolios to achieve their financial goals.
Moving on to category 2, nose. Green peppercorn, pencil shavings, dark chocolate. I'd give this a 5 out of 7.
Yeah, I think it's got a very nice aromatic nose. I'm going to give it a 6.
So as we can see, the nose of a wine has a range of aromas, as asset allocation has a range of asset classes. Could you talk to us about what defines an asset class and what are the different types of asset classes?
Bonds, which is a big global asset class, that's effectively lending money to companies and governments. And what you do is you'll earn interest on that bond. If it's a very short-term bond, you're not going to get much price movement. But if it's a long-term bond, in other words, like a 20 or 30-year bond, you're going to get a lot of price movement. And therefore, you can make a return both on the interest component as well as on the price component. So that's bonds, big asset class. Other obviously big asset class we all know is equities or shares. You become a shareholder in a company and you can think about any number of big companies, Apple, Microsoft, Anglo-American. And then what you're really depending on is that the management team in that company will deliver returns for you over time. They will grow the company, they will reinvest in the company, they will also in many instances pay out a dividend that you can either keep as a cash or you can reinvest. But essentially you're betting on companies growing their profits, you're betting on economic growth, you're betting on innovation, etc. In that category we can also include businesses that rent out physical assets like a property company, landlords, etc. And then in the third category of trading, you really would have things like gold, right? So if you're buying gold today, you are doing so in the hope that it's going to rise in price and that you'll be able to sell it tomorrow for a higher price. And to the extent that crypto is an asset class, it also falls into that category. And of course, a lot of people make money by trading commodities, but also just financial instruments. And they don't care about specifically what they're buying or selling. They just care that the price is going up and the price is going down. So each of these asset classes would have different risk and return characteristics. So we would expect over time that equities will give you a better return, but equities are also going to be more volatile. Whereas bonds will give you a steadier return, but it's going to be less than equities. And obviously something like cash, like leaving your money in the bank or in a money market fund, there's going to be no volatility. Mm-hmm. But your return is also then capped by whatever the prevailing interest rate is.
Now closing off with palate. Dark fruits, red cherry, cigar box, tobacco, cassis. I love that. 8 out of 10 for me.
That's very good. I'm going to give it a 7.
Tough scorer. So this one is a blend of Pinotage, Cab Sav, and Cab Franc, with the quantities being decided by the winemaker. So with asset allocation, how does the portfolio manager decide on the quantities to blend the asset classes to meet the investment objective of a client?
Well, it all starts basically with the mandate or the specific objective of a fund, right? So if it's a fund that is meant to generate higher returns over time, that fund is going to be quite heavily invested in equities because, as I said earlier, equities will give you the best return of most asset classes over the longer term. So that is going to be a fund that's going to have a lot of equities, maybe 70%, 60, 70% equities, You also obviously get 100% equity funds, but it'll be determined by the objective of the fund. If you invest in that type of fund, you should expect that it will be volatile, and you should not focus so much on short-term returns, but rather look at longer terms. On the other end of the scale, if your demand is that I need to earn income, if I'm, for instance, in retirement already and I just want to earn a steady income, my portfolio is going to be much more heavily tilted towards interest-bearing assets, cash and bonds. However, even if you are, for instance, in retirement and have an income need, you might be in retirement for 20 years or 30 years. Right, so you're still going to need some sort of growth element in that portfolio as well, and that's why typically, retirement income portfolios will have still an allocation to equities in order to drive that long-term growth. So it really comes down to what is the objective that the client wants to achieve. That'll determine which type of fund the client should invest in, and then the fund will be managed with the appropriate mix of asset classes to get to that target. Maybe just one last point. I think the benefit of combining different asset classes together versus going 100% in one asset class is obviously diversification, because typically what happens is if there is a weak patch in one asset class, for instance in equities, often your bonds are doing better. Mm-hmm. So there's a bit of a buffer, and because the world is always uncertain, and we don't really know what's going to happen tomorrow or the next day, I think that diversification benefit is always quite powerful. And then of course you can diversify within an asset class. So for instance, when we talk about equities, we're not just going to invest in South African equities or JSE listed equities. You will want exposure to global markets, to the US, to Europe, Japan, etc. So that diversification principle, that blending principle is always absolutely important in everything that we do.
So closing out with final scores is a shared 16 out of 20 for the Warwick Three Cape Ladies. I'd like to thank our director Sunny Ho and our guest Izak Odendaal. To our audience, I hope you enjoyed learning a little bit about asset allocation. Please remember to like, share and subscribe, and don't forget, nothing pays better than Corks Capital. Cheers.